All right, everyone, welcome to week 13 of Selling Weekly Lottos. Every week, I sell options in the stock market to gamblers, and that's how I make passive income. These options are similar to lottery tickets because there's a very low likelihood of the option buyer to win. All right, people just call those lottos in the community. All right, so first things first, always do the disclaimer. All right, number one, I don't use margin. All my stocks or all my options are covered by having the shares or having the cash. Don't use margin. I don't sell naked calls or naked puts. All right, number two, I'm happy to buy the shares or sell the shares if I'm assigned. All right, so don't do this if you're going to be sad about losing your shares or having to buy them if it goes past your strike price. And then number three, this is not free money. All investing carries risk. All right, that being said, the winner this week is me again. That's 12 out of 13 weeks I've won. I've only lost 1 week, okay? That's because I'm the seller of lottery tickets. Very rare for someone to win. All right, this week I made $1,049 using $79,000 in collateral. All right, let's talk about the positions. All right, number one, boom. All right, so this, again, I've talked to you about this before. This is a covered strangle. All right, covered strangle is when you sell an out of the money call and sell an out of the money put on the same stock that expires on the same day. So this one was BitX. I sold a 68 call and a 53 put. The 68 call I sold for $431 and I bought it back for $10. And the 53 put, I sold it for just above $500 and bought it back for around $250. All right, the profits there were about $700. All right. And then, boom, the hood, I just initiated a contract position on this hood. I'm starting to really like Hood, Robin Hood, investment company, brokerage. All right. I sold the 100 puts, 2 of them, for $600 in total. And I bought those back for almost $250 as well. And that was around a $350 profit. All right, so this week was pretty weird. The covered call on BitX, I was lucky to sell it when it was pretty much peaking, and the next day it dumped. So the contract went down like 90%, 95% in literally like 1 day. All right, but the bad thing was because the stock went down, my puts went crazy. I sold them for like $1 each. And they went up to like $3 to $4. So that was around a 300%. Like I was technically down 300%. But that was rough. So then the next day after that, it recovered and the contracts went down about 80, 90% from their peak. And that's why I closed them early. So even though I only sold them for $1 and bought them back for $50, it doesn't seem like a big like profit. If I was considering that they went up to like 400 and then went down to $50, and I was like, okay, let me get out of this in case that happens again. All right, similar thing happened to Hood. The puts I sold for $3 each. All right, and they went up to like 400 or 500 or $4 or $5, right? And then they went back down to like 50 cents. So I decided to take the profits. All right, let's go ahead and take a look at my benchmarks because this is actually 3 months now. 13 weeks is 3 months, and that's an important number for finances because that's 1/4 of the year. So this is technically what they consider a quarter. All right, so this is a quarter. So let's look at my benchmarks. Bam! All right, let's take a like focus in on the averages here. All right, so after 3 months, I've made almost $17,000. All right, and that's using just over $130,000 worth of average risk. On average, I'm only using about $130,000. right? That's almost $1,300 a week, and that's just barely below 1% per week. And if I was able to continue that for a full year, that would be an annualized $67,000 per year and around a 51.5% yield. These numbers are absolutely bonkers, guys. So I'm starting to believe after 13 weeks that this is a really strong strategy and think it's really good. The only thing is the market has been on easy mode since that crash in February, March, and then it started recovering in April. So this is really an easy mode market for the past 3 or 4 months. And so I'm not going to make a definite decision that this is the best thing that you can do yet until the market goes back to hard mode and to see if this is sustainable, if the market is correcting for a long period of time. But as far as I know right now, this has been really good. $1,300 a week, guys, using $130,000. How many people are paying like almost that much in debt, right? If you had debt, you'd be paying that instead of getting that. So save your money, guys. Invest, save, and start stacking up your brokerage accounts and your savings accounts so that you can use your money to make money. All right. If you are starting to believe in this and considering it or wanted to try it, this is what you got to do. There's 2 requirements, or 1 requirement, but technically 2. You have to either have 100 shares of a stock, or you have to have the ability to buy 100 shares of a stock, or both. All right? Or both, but not neither. All right? If you do have 100 shares or the ability to buy 100 shares, what you're going to do is go to your brokerage, go to the stock, all right? And then you're going to select options. And then what you're going to do is find the price. The strike price is the price of the stock you either want to sell or buy. And then the expiration date, whether it's next week or next month or next year, whatever, if the stock even has the options available. Then you're going to select sell or sell to open. All right. Then you're going to type in your price. All right. You can either use a limit order or market order, just like stocks. All right. And if the order goes through, what's going to happen is you're going to have a negative contract. This is really important because it's the reverse of traditional investing. You're going to have a negative contract. You're going to go from 0 contracts to -1 contracts. All right. This means you are short the contract, and in order to close the contract, you have to buy it back. All right. And that will be the trade. So traditionally, if you buy a stock, let's say for $50 and sell it for $100, you make a $50 profit. But with this and what I've been doing for the last 13 weeks, you sell a contract for $100, and then if you buy it back for $50, you go back to zero contracts and you collect that $50 profit because you bought something back for $50 that you originally sold for $100, right? So it's the reverse, all right? But that's important. So you could buy the contract back, or what might happen is your contract could get assigned. So if it goes past the strike price of the call or past the strike price of the put, you might have to buy the shares or sell the shares. All right. And then lastly, the reason I think this is the best strategy and so forgiving and so strong is because eventually the options are always set to expire. All right. And that benefits you as the seller because eventually the contract may expire worthless and you'll basically buy it back for $0, getting you back to that 0 contracts, and you'll make the full profit. All right. And that's why I think this strategy is so strong. So if you have any questions about this, let me know, and I'll try to explain it the best I can. Otherwise, I'll be seeing you guys for next week. Peace.